Hi, folks. It's Isaac with Cordant Wealth, and welcome to our third quarter market update for 2021. So, what are we going to talk about this quarter? We have a few things to choose from. We've got the collapse property development company in China. We've got obviously supply chain issues and employment issues. We've got things going on in DC or things not happening in DC. We get debt ceiling debate debacle that actually got extended to the fourth quarter. So maybe we get a chance to talk about that again here next quarter. And also potential tax changes. Are they going to happen? What's going to happen? And we're going to have to stay tuned there. But today we're going to focus on what happened in the third quarter in the markets. We're going to talk about inflation. That's a hot topic. Something that's on everybody's mind. And we're going to look at it through the lens of two different types of recessions and what that can actually mean for inflation and things going forward. And then I'll talk a little bit about a stagflation as well. Obviously, that's kind of the worst case scenario when you have high inflation and an economy that's not growing. So that's what we're going to hit today. So stick around and we'll get right into it. Okay, so first up, let's just talk briefly about returns year to date, and then we'll break it down by different areas of the market. So as you can see, markets were down just slightly in the third quarter, but still overall pretty good year so far in 2021. So let's get into it. So what areas of the market did well? What areas of the market didn't? And across the board in most markets in the third quarter, really we didn't see much of a move. So equity markets, at least the developed equity markets, US and international, just down very slightly. Bonds up very slightly as interest rates fell a little bit. Real estate, not a big move in the third quarter as well. Only area of the market that we actually saw make a significant move one way or the other, at least across stocks and bonds, is the emerging market. And some of that's due to everything that's going on in China. We'll look at commodities here in a little bit because obviously so far year to date, they've been a pretty big mover. And we saw that again in the third quarter. One thing that I did want to touch on, and we'll see this here in a little bit, but the last couple of quarters have not been very good, very strong for value versus growth. And what we can see is a better performance in the first half of the year there and lower performance in the last couple of quarters. But overall, in general, if you look at global value, that's actually still outperformed the broad markets year to date. And here in the US, small value has been one of the better performing sectors year to date. So quick check in there. What we'll see here in the US market was, again, large growth being best performing area of this market as it was in the second quarter. Small growth and really small cap stocks generally were lower performing in the third quarter. On the international front, here where we actually saw was small cap, best performing area, value, large value, worst performing area, but not a big move in international stocks in the third quarter. Emerging market stocks, we saw a bigger move there. Obviously, we saw earlier that large cap stocks there are down about 8%. Small cap stocks here actually held up better, down 2%. And again, that's kind of a reverse of what we saw in the US. So again, kind of a recap year to date. We've seen commodities be a top performing asset class, followed by US small value and real estate. Those have kind of been the best performing areas so far to year to date. Didn't really see that in the third quarter nor the second quarter, but year to date, those areas have held up best. So speaking of commodities, I think it's worth checking in there a little bit. And again, once what you can see here is a pretty strong returns, especially natural gas being a big one in the quarter. So in the quarter, overall, a broad index of commodities up about 6.5% for the year, up nearly 30% for the commodity index across the world. So that kind of sets up the second part of this market review, which is to talk about inflation and kind of what we're seeing there. So let's shift into that. So when we look at inflation, kind of the headline numbers is the consumer price index. And what we saw in September was a 5.4% year over year change. We saw a 5.4% a couple months in a row here, year over year. And really, that's the highest inflation we've seen since going back to the global financial crisis, which you can see they're shaded in gray on the slide. So, one thing we want to look at is just kind of like, where it's coming from, what might be driving it, and what that means. But before, just a little bit of context. So one good, nobody really likes inflation, but a couple things to note here. So really inflation matters as it impacts your purchasing power. So one thing to note, if you're taking Social Security payments actually going to increase 5.9% in next year, starting in January. So actually, increase in Social Security actually has outstripped inflation over the last year. The other thing to note is, global stocks are up about 30% over the last year as well. And so while, most people aren't going to have 100% of their money in stocks, they're going to own some bonds as well. But there has been a strong return in the equity markets, and for those that are drawing Social Security right now, that actually is keeping pace with inflation. So just a couple things to kind of put this in context. Another thing that I think helps is to break that down. So where's that 5.4% coming from? What's actually driving inflation? So this is a chart that was put together by BlackRock, and it breaks down inflation across different categories that the Bureau of Labor Statistics is going to put together in terms of where inflation is coming from. So what you can see here, remember that 5.4% number. What you can see across these different categories: housing, food, medical care, transportation, education, etc. None of them, other than transportation, are actually above that headline number. So it just gives you a sense of what's driving a lot of this inflation, and it's in the transportation bucket, or the transportation group there. So something to keep in mind is that shifting. Obviously, food is a type of inflation that people are going to see basically every day or every week as they go to the grocery store. And obviously, we've had some inflation there, 3.7% on average. Obviously, some things have gone up more than that, but on average, that's where we are. So definitely worth keeping an eye on: housing, food, some of those things that we see all the time to see how inflation is changing. But I thought this did a good job of breaking down just what's driving that headline inflation number. See, the other thing that I wanted to get into here is a little bit about why we're seeing some inflation. And I thought a good way to kind of break this down is from looking at it from a recession standpoint. So obviously last year we had a recession, a COVID shock that sent us into a recession. And that was a different kind of recession than we typically had. So typically, and we can look at a slide here. So typically, recession is going to be driven by a demand shock. So something happens, with the global financial crisis, like there's a housing collapse. There's a big collapse in demand. People were spending less money. People were out of work, and they were obviously then spending less money. And so typically what you'll see is an income drop on a demand shock, or a demand side recession, which is going to play out in that people buy less goods, durable goods, things like that. So people aren't going to buy the TVs, the cars, the things like that. Typically, in a recession of this nature, your services tend to hold up pretty well. You still need to get your haircut. People are still going to eat, things like that. And so what happens is, on the manufacturing side of the economy, manufacturers are going to cut production, and they're going to get rid of their inventory. And that's kind of the normal recessionary playbook. So spending is down, manufacturers are going to cut what they're producing, and therefore they're going to get rid of inventory and make the inventory as lean as possible. So that's kind of the typical recession, the typical playbook. What we saw in this case in the COVID recession was more of a supply shock, or is more of a supply shock. So in this case, income didn't drop. Actually, it went up. And that's because of a lot of transfer payments from the government to individuals. But you actually saw income increase in this recession, which is not normal. An effect of that, kind of goods and services go hand in hand. This was an opposite recession from goods and services perspective. You actually saw consumer spending on goods go up. So people are locked into their home. They have extra money because the government's transferring in their money. They are spending money on the flat screen TVs, or maybe the new cars, or other things, other tangible things, computers, webcams, like anything, because everybody is connected via Zoom or other technology. A lot of spending there. You saw services spending actually decline, which is typically very stable in a recession. Actually saw a decline. You were trapped in your home. You couldn't go out and spend on services. You couldn't get your haircut. You couldn't go out to eat, etc. And so that those spending on those services actually dropped. So then, what did we see? Well, manufacturers actually followed the typical playbook that they have in past recessions. So they cut production, they bled inventory, expecting a drop in consumption of goods, which is a normal thing to do in a recession. Um, and so that's kind of gets us where we're in the environment where we are today, right? Where manufacturing cut production, they bled inventory, and now we're sitting here with shortages and kind of inflation on goods happening. So different recession, people following the same playbook as normal, but it has led to this environment where there's supply chain bottlenecks, ships anchored offshore, and starting to see some inflation in the price of goods. So a couple data points to back this up. This is a chart going back to 2008, and you can see uh, just how the blue line here is services, and you can see how stable that is in a typical recession, the 2008. And then red is durable goods, and you can see how typically that's going to drop in a recession. And in this environment, we're actually above where we were pre-COVID, and services spending is still trying to make their way back to where we were. So I think that's a lot of what's driving what's going on in the supply chain. Here's just a picture of how many ships are, a chart showing how many ships are actually anchored offshore trying to unload their goods at the ports. And while it's come down a little bit, it's still much higher than it was a year ago. So I think that's some helpful framing for what's going on in the supply chain and why we're seeing some inflation in goods. So what does that mean? I think that's what we want to get into next. So does this mean we're going to have runaway inflation? And does it mean worst case scenario, we're going to have some stagflation where we both have inflation, prices going up, and a slow growing economy, which is kind of the worst of both possible outcomes here. So couple things to put this in context. So one, just inflation expectations. Like what is the market expecting over the next 5 years for inflation? So a lot of people are going to say a lot of different things about inflation, but when it comes down to it, this is what the market is betting. There are people on both sides of this, people looking for inflation to be higher than this and lower than this. And so this is actually, you can invest money on is inflation going to be higher than this or lower than this? And so the market consensus right now is for 2.4% inflation over the next 5 years. So slightly higher than the Fed's target of 2%, but obviously not a runaway inflation. So again, a lot of people saying a lot of different things, but in general, what the market's expecting is it's a little under 2.5% inflation over the next 5 years. The other thing to look at is kind of stagflation. What's going on in the economy? Are we going to get? Is all this inflation? Is this the 5% inflation, the growth in commodities? Is that going to really cool off the economy and allow or create an environment where growth isn't really possible? So here we want to look at a couple things. So a couple of things are going to go into this. So one is just what's the health on the corporate balance sheet side and what's the health of the consumer. If corporations are healthy, if the consumers are healthy, it's hard to imagine a scenario where the economy doesn't continue to grow and recover going forward. So first thing just to note is high profits on the corporate side tend to lead to investment, capital expenditures, which obviously is going to fuel growth in the economy. So what you can see here is just the relationship between the two. When profits are high, capital expenditures tend to be high as well. And what you can see here is profits are high. We would expect capital expenditures from the corporate side to follow that, which would be supportive of growth. The other thing that would either drag growth or fuel growth is just how much debt does the private sector have right now, or the households have. And what you can see is that it's really at a historically low level. So consumers used a lot of this surplus income to actually pay off debt. So the U.S. consumer is in a pretty good shape. They also have a fair amount of cash that they're holding. So bank deposits are historically high. According to this analysis, there's about $3.3 trillion sitting on their out there in bank accounts. It's actually excess savings that people could spend as things loosen up. So U.S. consumers in a pretty good spot. And then companies, one thing that companies can do if input prices go up is raise prices. And what you're seeing is companies are actually doing that. Obviously, that's passing it on to the end consumer, but from an investor perspective, that should be supportive of higher earnings per share, which obviously is a good thing for those that are investing in the equity market. So big picture, yes, commodity prices are going up. Some of that's due to, or a lot of that is due to some supply chain issues, constraints, labor shortages. Truckers to drive the trucks, people to unload the container ships when they land in the ports. Hopefully, all that stuff gets sorted out. It doesn't sound like there's going to be any solutions here in the near term, but the next year or two. But a couple things to remember, a couple things that I think are important here is, by and large, the corporate sector seems to be healthy, good profits, able to invest back into the economy, grow the economy, and the personal balance sheets of the U.S. consumers tend to be in a pretty good spot as well. Low debt, high cash in the banks, which again should be conducive to growth. So might see some more bumps in the road for sure as we go into the holiday period in the fourth quarter and on the supply chains. But definitely from a growth perspective, things look pretty healthy. And from a stock market perspective, obviously that would be positive. So hopefully that perspective helps. That is our recap for the third quarter. Look forward to doing this again in the fourth quarter, and we'll see what that has in store for us. Hope everybody has a good fall, good holiday period, and we'll talk to you after the fourth quarter. Okay, thank you.